Yeah. Okay. So hi everyone. So we have Michael Heisterkamp here today. So he's the co-founder of Corewant. And this is, as you guys know, finance meets real estate. We meet here every Tuesday, 6:30 p.m. Eastern time. We have amazing guests like our guest here today. So far, we've had over 100 different guests on this program, and it goes on YouTube. So make sure to subscribe and follow us on YouTube, Finance Meets Real Estate there. And so today's topic, so we're gonna discuss so my favorite favorite topic, pretty much real estate technology. So today's topic is real estate lending 3.0. So harnessing technology for growth. So Michael is the co-founder of Corewant. So this is a technology-powered real estate investment lending marketplace. He has over 2 decades of experience across all verticals of real estate, and he brings a lot of knowledge. We've met in person with him in New York a few times. He has a great story to share. So I'm really excited to have him here today. And with that, Michael, I'm going to pass it on to you. So we'll do kind of like a Q&A. And if anyone has questions, feel free to speak up and, or just put your questions in the chat and we'll relate at the end.
Yeah. I mean, I guess I can give a little bit of a background on myself. As Stefan mentioned, I've been in a number of different areas in the industry, from everything from, like a direct access on the asset side. So, buying and selling property, have flips, rentals, all the way from, single family stuff into the commercial space. Had a very odd childhood. I drugged my parents out to look at properties when I was very young. And, it sort of snowballed from there. I studied it, of the normal stuff, finance, accounting, it's economics in undergrad. And then after I got out of undergrad, that was right at this, the beginning of the financial crisis. So it's had a real period there of opportunity in the commercial space. So as I pivoted there, started doing heavy lift rehabs, and I grew that to a rather sizable portfolio. Then I was like, hey, I'm kind of, I'm sick of this. So I did a very short stint in retirement. I found out that's very boring when everybody else who's retired is 40 years older than you. So ended up it's going to grad school, and that's where I met my co-founder, and kind of have been involved in more of the technology side of the industry since then. Everything from AI to its marketplaces, and that's primarily where we're focused now.
So that's pretty interesting. So Mike, actually, so just to kind of get a little bit back on that part, I guess. So when you actually started, so you started right after undergrad first, right? Is it like a theory investor, real estate investor?
Yeah, so I actually started before that. I started as, like a young child, dragging my parents out to look at properties. But it was after college that I actually started, purchasing and doing deals entirely on my own. And it was a really unique time in the marketplace when commercial properties were, at rock bottom prices, and you were getting, a DSCR ratios of 2+, and they were climbing. I mean, rapidly.
That was which year? That was so after GoFundMe, like that was like 2009, or was it like after?
Yeah. So I bought my first deal in 2010, like early 2010. So just probably I would say I did a front running on the bottom of the market, but by probably 5 months. But it was a heavy lift deal. Like I went and gutted the whole building, added floors to it, and
there was like how many units? Just curious.
Yeah, it was a mixed use. It was a mixed use property. That one had. When I bought it, it had 14 units, and when we finished, it had 28. So if we doubled the density, it's and then went in and did gut renovations on everything, and brought like that's a big part of my investment philosophy is I want everything to be the exact same vintage. Like I don't want to have air conditioners and
Sure.
hot water heaters and refrigerators. So they're all different ages because then it's just
Okay.
way
Mhm.
more complicated. So
Okay.
if we went in, basically toward the, not literally toward the building down, but basically, and then it's completely rebuilt it over the course of, I believe that was a 10.5 month project. And then, yeah, over the course of that next 5 years, I built that portfolio up to, at largest, it was 144 units, if I remember correctly. Yeah,
Mhm.
that's correct.
Got it. Got it. So that's it. So you were essentially that's what you were doing. And you got bored with it, and because naturally, it's not the most interesting thing to do, right? And I
Yeah, yeah,
agree.
it's well, I mean, so the boredom came more out of the market
Mhm.
shift. So that was, by the time I wrapped up my last, like, I guess it's finished the last project. It was mid 2015, and the
Mhm.
market had shifted significantly. The basis on acquisition for assets that I was purchasing doubled over
Mhm.
the course of the period of, it's when I made my last purchase and when I finished. It's you know, the renovations on that
And
building.
those were in the New York City area, or like
No,
what?
that was in the south of the
Oh,
Dallas
those
Fort
in the
Worth.
south. So like Florida,
Yeah,
or
no, of the Dallas Fort Worth area.
sorry, that was for got it.
Yeah.
Oh no, that's great. So that's where you were actually. So you used to live there actually yourself
Yes,
in
correct.
Florida.
Yeah. I grew
Okay.
up in the Dallas Fort Worth area, so yes.
Okay, because just like for our audience, you're now in New York, so in New
That's
York.
yes. I'm
Yeah,
I'm
sure.
in
Okay.
Manhattan now, but yes.
Yeah, got it. Okay, interesting. So that was so through mid 2015. Okay, the basis got sort of doubled. Like everything was the DSCR ratios were all way worse. They were no longer two, presumably,
Yeah.
so forth, right? So you decided you're bored with doing the same. I mean, it's not the most exciting. It's a profitable business model. It's not the most
Yes.
fun one for sure. Right?
Yeah, it's like, I mean, like, I still enjoy it, right? But I was just bored not being able to find deals. And that was the big thing.
Okay,
It was just like repetitive underwriting, and
I see.
nothing's coming up. So I was like, why am I doing this? I don't
I
need to
see.
do this. I could never work a day in my life and I'd be perfectly fine. So I decided, screw it. I'm gonna if I'm gonna go retire. And then I realized very quickly I hate golf and I don't know anybody.
Oh, I see. So kind of like the deal finding kind of frustration, right? Or I see.
Exactly,
Okay.
exactly.
I understand. Yeah, that makes a lot of sense. I mean, it sure and sure it has got like much more saturated even since then, right? I mean, it's
Oh,
everybody's doing it now, so there's some.
yeah, yeah. By that time, the syndication model had really exploded. There
Like
were
2015.
tons and yeah.
Yeah.
There were tons and tons of people who were teaching people it's how to syndicate, and all that kind of stuff. So the number of people looking for deals, I don't know the exact number, but
Mm.
just based off of what I was hearing from brokers I worked with, it over doubled, in the course
Yeah.
of a year.
Yeah.
And
Yeah.
it's just like it's tough to compete when there a lot of the syndication model is based around doing transactions. So it's like the, it's in their best interest to pay more than I would to get the deal done because the syndicators are making fees on deals,
Sure.
which
Yeah.
is fine, which is
Yeah.
fine. But like, I'm running my own capital. Like, I
Yeah.
don't get paid to buy
So you
buildings.
weren't actually syndicating. You were only kind of
Yeah,
JV, only
yeah.
your own capital plus JV, or just yourself?
No, no. It was strictly like it's personal and like family capital.
Sure.
So yeah,
Got it. So it wasn't even JV, right? It was just basically
yeah,
just have your own.
exactly.
Yeah. Well, but the family capital, wasn't that a little bit like capital raising in a way, or not really?
No, not particularly. That had
Mm.
more to do with the fact that I just made family members a lot of money.
Okay,
It's
sure, yeah.
it's while I was younger, because I mean we did 88 deals between I when I started. It's looking for properties as like a 10-year-old, and it's by the time I graduated high
80
school.
deals.
88, yeah.
Wow, that's incredible. That's a
So
huge it's a huge
yeah,
volume.
yeah.
Mhm.
Yeah, so like,
So presumably, I guess some of them were residential, looks like, right? Based on
oh
the
yeah,
one of them was
those
that,
were
right?
those were all of those except I think 10 of them or 11 of them were
Yeah, yeah.
2 to 4 unit properties. Yeah.
Got it, got it. And those were also in like in DFW, like Texas area or other?
Yeah, they were all also in the Dallas Fort Worth area. So
Got it. Okay. Okay, great. So with that, okay, so it's like 2015, and you're kind of, the market is already very different. There are many people watching podcasts and jumping into syndication, presumably, right?
pretty
And
much,
doing that.
yes.
So pretty much, right? So then from that point, so you decide to kind of do more interesting work and kind of help the industry through via technology, right? So how did you start there? Like, what was your
Yeah, so
goal?
actually that was quite interesting. No, I didn't actually move into the technology side of the industry at that point.
Okay.
Um, I decided, you know what, I'll go back to school because it's like I can go get a graduate degree, I can network with people, I can meet people, do all that kind of stuff.
Mhm.
Ended up at Harvard, and that's where I met my co-founder, and him and I actually were completely off topic, but we were it's working on a healthcare technology company. And then he actually showed me a project that he did for a machine learning course.
Yeah.
And it basically was an AVM system, which for those of
Mhm.
you who don't know what that is, like
Yeah.
it's an like automatic
Oh,
evaluation
yeah.
system that
Yeah.
basically, predicts what prices are going to be. And it turns out that their system with no financial data was absolutely crushing everything else. Like
Mhm.
uh AVMs with financial data, humans with financial data, everything. Like
So that
the
was for
best
real estate or for other things?
what
That was an AVM for real estate.
yeah, for a commercial real estate
For
specifically,
commercial
only
real
for
estate.
commercial. Yeah.
Mhm.
So it was absolutely crushing everything. Like I think the best model on the market at that time was had a 6% variance between prediction, almost 6% between prediction and transaction price. Humans were at about 3.5, a 3.2 to 3.5%, and we
Mhm.
were sub two, which for you, for those of you who are not super adept in statistics,
Yeah.
that is that's orders that's orders of magnitude away from the it's the
Yeah.
middle of the distribution.
Yeah. Yeah. No,
So
that's like that
yeah,
sounds amazing. Yeah. And so that's and just like to give even like some color on that. So I've met your co-founder Philip, right? So
yeah,
he's a data science, I believe, data science major or machine learning engineer from Harvard, right?
yes,
And
correct, yes,
so yeah, so he introduced you to that model that for AVM or what happened, which is yeah, that's quite incredible that you guys had like this predictive power there. And so what happened then?
yeah. So basically, what happened at that point is we were already we were already kind of under the understanding that our healthcare tech company just wasn't getting the traction is that it needed to, continue to raise capital. So him and I left it's that company and we went out and started, like an AI company in the commercial real estate space. It's essentially trying to sell, um, you know, this service to other investment firms. We pulled in a couple of early lighthouse customers, who were letting us use their own data as well as like data that they were currently purchasing. And, we continued it to build the system out, but it became over the course of about a year of working on this, it became apparent that it's the the business model of that is really difficult to sell,
Mhm.
mostly because if you're buying, a $500,000 a year product from me, you want that to be like, a turnkey product. You don't really want to have to go out and then buy, hundreds of thousands or millions of dollars worth of data on top of that. Like it
Mhm.
really takes the value away and it shrinks the number of potential customers. We were looking
Yeah.
at, initially a few thousand potential customers. And by the time you factor in all the data cost and, everything else, that customer pool quickly shrank down to like maybe 100, 120 at the like extreme end, because the funds who are big enough to absorb a cost like that, you know, they're the only ones that are going to benefit from something like this. So we, it's kicking it around and like really trying to come up with ways of creating data, essentially. So, and that's where its correlate actually was developed from. It was like, hey, let's just throw up a website, you know, collect information on, for it's hard money lending, and just broker some loans, because I've been brokering a loan, just
Mhm.
in like,
But but just
just
if I may interrupt, sorry, Michael, just that part, the initial product that you guys had that you were pitching to these like few thousand potential customers, kind of after accounting for all
yeah.
costs, actually 100, and sort of determining your viable market in a way, right? How big is
Yes.
it, so forth. And so that product, what kind of data you guys were selling specifically? Like what kind of AI
So
or
yeah.
real estate you
Oh,
were
we
doing?
weren't. Yeah. Oh, we weren't selling any data. So like
Okay.
we were selling like analytics on underlying data.
Uh,
So it included just about everything you can possibly think of,
mhm,
as a data input. I mean, we had like systems that were counting, like in dense urban areas, was measuring the distance between the buildings and trees, right?
mhm, yeah.
Which is like sounds ridiculous, but when you get down to it, all of these little attributes, as they're called, can create like correlational links to
Mhm,
a building transaction value, and you can
mhm,
actually create the underlying financial set with
mhm,
these like it's correlated like attributes and the weighting that those attributes have on the exit valuation of
mhm,
buildings.
mhm.
So I mean, obvious things will matter, like the class of the building, the age of the building,
Sure.
how tall is it, et cetera, et cetera. But what we were discovering was that like you can not just predict what the transaction price is going to be, but if you work harder on it, and this is the problem we never fully solved, to be honest with you, but if we were getting there, was
Mhm,
that we can actually go down to like the block level and predict growth, like a different levels of growth in the future based on like structured attributes. So it's like a building here and a building right next to it, right? If they're on the same block, they'll have different growth potential values based
mhm.
on like the retail exposure just in like a city, like a mixed use building in a city,
Sure.
based on the retail exposure of where they are, like
Mhm,
on avenues and streets.
mhm,
So it's like, depending on like if you're for example, if you're driving toward a stoplight, the buildings that are on the opposite sides of the street of you from that light have better its retail exposure than the buildings you're actually like stopped next to.
right.
So
Mhm,
what you can potentially charge on those spaces is a little bit higher than what you can charge on the other side of the street, all else being equal. So
mhm.
it's
But
like
that's
you can
what you were focusing on. Like, did you have like retail apartments, like few property types there, or
no, we had everything. Like
you had
it
everything?
didn't matter what it was, but we
Mhm.
could do it. Industrial, it's multifamily, mixed use, retail,
Let's say,
land, even to an
done,
extent.
right.
So yeah.
But you would kind of, your business model, once you have like customers interested in a specific neighborhood, you would sort of pull the data on all properties at that
Yeah.
point and kind of scour and collect like distances versus streets and all those things at that point, or you would be maintaining a database.
No. Oh, we would actually have that already. And
You would
then
have
if
that
we would,
already. Uh-huh.
yeah, yeah. And then if we would integrate their data into the system,
Mhm,
and then we would, or it's the concept idea was that like, hey, the underlying models here, it's evaluation and growth already exist in our own database. Oh, we're
mhm,
gonna like take your data, integrate it. Oh, we're gonna use it to like drive inferences about what you actually buy, and then target undervalued properties of similar types in the area,
Mhm.
be they for sale or not.
Mhm.
So like say, hey, this property at 1234, a Sixth Street
Mhm.
fits your profile perfectly.
Mhm.
Hey, this is the contact information of the person who owns it, or this is where you can find it,
Mhm.
and like this is what you should pay for it. This is a propensity for growth in a year, 3 years, 5 years,
So
based on
it was an AVM that would really collect extremely quality structured data in the immediate vicinity of a
yes,
property and also forecast growth. So that was
yes,
kind of the concept essentially, primarily,
yes,
right? And or you would also sell that structured data potentially, or not sell it, or I don't know, whichever analytics on top of structured data, right? And so forth.
yeah,
And
yeah.
so
So
okay,
we never sold the data. The data
yeah,
never got sold. It
okay,
was only the outputs and the results. So the
right,
analytics. Yeah.
understood. Okay, got it. And from there, you guys move to what you're doing now. Is that correct? Like the
Yeah.
within the lending.
Uh,
Mhm.
yeah. So it's just before if we get to the lending company, it
Mhm.
actually came out of the AI company. It was like we were kicking around ideas for like how to collect data. And this is kind of what I was saying earlier, is that we had like I have been brokering hard money loans just kind of like on the side, just every now and then, because I know people who need money and I know people who have money. So I just, I make connections there. And then I was like, let's just throw up a website. It probably won't be a ton of data, but like we can collect some information, at least augment a little bit of this.
Mhm.
And we started doing more and more research on the market, and we're like, it's huge. I mean, like currently there's over 100, like 104, 105 billion a year in lending, like on these sort of what are known as asset-based loans.
Mhm.
And like currently it's expected, to grow like more than double in size in the next 5 years. And, there's a huge fracture in the market. I mean, at any given time, there's roughly 8,000 or more of these lenders all over the country. And they do
Mhm.
everything from like national scope to guys who are lending in specific neighborhoods to
Mhm.
like, like a handful of people that are in their local city. So it's
Mhm.
like, how do we build a marketplace that will allow newer investors or even seasoned investors connect to more sources of capital, and allow them to do it in a transparent and easy to understand manner, because it's like
Mhm.
oftentimes comparing these loans is you'll pull your
Right.
hair out, because like they're
Right.
quoted entirely differently. So it's like is
So
you might have
yeah.
like interest rate, origination, and it's like, okay, well, a group A over here rolls all their fees into the origination, underwriting, appraisal, everything goes in there. Other It's other groups are like, hey, it's just origination fee, and
Mhm.
here's five other fees, is you have to pay independent. So it's
Mhm.
like if you can get a 10 and 3 offer and a 10 and 2 offer, and it's like which one's actually better, it's not always clear until they actually spell it out.
Mhm.
So
So, but just what do you think drove the like this kind of growth in asset-based lending? Because I've kind of seen it on the side myself, and I know Finance of America Commercial, they did like a SPAC IPO that I believe was valued at 1.9 billion. I've seen like some of the other companies like Lima One and so forth, and not to mention too many names, but that really kind of grow and gain popularity. I feel now maybe they a little bit with some of the rate changes. I guess their permanent financing product seems to be less competitive, I guess, and
yes.
their flipping type, bridge type of product seems to be kind of equally competitive as it was, or maybe more competitive. But yeah, but what do you think is driving that? Is it like essentially the fact that it's asset based? You can be kind of off the system, not working, not having a full-time job, and still borrow and do that, or what?
Yes. So yeah. So that is a big part of it. But honestly, it goes back to Dodd-Frank. Like the Dodd-Frank, banking regulation laws after the 2008
Mhm.
financial crisis
Yep.
is really what drove like the expansion of this market. I mean,
Mhm.
it existed in the the 2006, 4, 5, 6, flipping boom period,
Mhm.
but it wasn't as utilized because you could go to your bank and get a 120%
Yeah.
mortgage,
Yeah.
which would roll in like your rehab cost, right?
Yeah.
So it's like if people could do this at the normal bank, now you can't. Like, I mean, it's just completely against regulations now. So it created this entire a secondary is lending market, and it's grown, you know, 5 to 8% like a CAGR every year since the 2008
Well,
financial crisis, and it's just it's only going to continue to grow because the the ability to secure uh, attractive financing from a bank is harder and harder and harder because
right,
they're more and more regulated.
right, right.
So
I was
yeah, I mean,
finding when the interest rates were lower, and I feel like also the asset-based lender, their spread over some of the other lending was not too huge also on permanent financing. I found that's a great
yeah,
product. Now you don't need to have a job. You can just buy even permanent financing real estate without having a job or W-2,
yeah,
meaning the residential space. Because obviously in commercial, this is always the case. But now people can kind of like purchase, like you mentioned, 2 to 4 family houses and so forth on that. So
mhm.
I thought it was a great value add, but then now the interest rate kind of shifts and the way the whole treasury curve is and everything, it's so different. So
Yeah, yeah. It has a lot to do with the fact that a number of the asset-based lenders that were offering long-term products have gotten into a huge issue, especially guys that were backed by banks, because like all these banks are holding riskier paper at what you can get on a treasury right now, and it's just like it's it it's crushing their a bank's its bond portfolios.
yep.
So, and I mean, because these are assets to the bank, they're bonds basically.
Okay.
So this is why you know they're they might be quoting 8-9% or more on a 30-year product, but the truth is they're quoting that because they don't want it.
Yeah.
Like
Yeah.
they're they're required to offer pricing, so they just price themselves hopefully out of contention,
Yeah.
and that's really what they're looking to do.
Got it. Okay. And so you guys, right? So your product, like what do you guys specifically do? So you're a real estate investment lending marketplace. So if you want to kind of go a little bit more into that, and
Yeah,
yeah.
yeah. So we service a real estate investors. Like that's our exclusive,
Mhm.
like it's product offering. All we do is asset based loans. Like we do not do any QM loans, which are for those of you who don't know, those are loans that are like personal guarantee basically with a normal bank. Like you would go to your JP
Yeah.
Morgan Chase or your Wells Fargo, and you are taking a mortgage to buy a house. That's a QM loan.
Mhm.
So yeah, like that's all we offer, and we actually do everything. We'll do commercial loans, but we primarily focus on kind of the 1 to 4 unit space, and that's really where probably 80 to 85% I would say of our deal flow actually comes in. And then we do another probably 10 to 12% kind of in the the smaller multi stuff, the 5 to 25 unit space. And
Mhm.
then the balance I would say is the true commercial stuff.
Sorry, so the big percent is in the 1 to 4, and then
Correct.
5 to 25, some percentage, and then
Yep.
balance commercial, right? Okay, understood. Got it. That makes sense. That's sort of like the way the asset-based lending distribution is, right? Generally speaking, in
Yeah.
terms of
Yeah.
their side, right? Okay, got it. But you guys like the way you guys add value is so is it essentially like mortgage brokerage for asset-based lenders, or is
Yes.
it okay, understood? And let's say what technological, considering like the backgrounds you guys have and like your partner has, right, in machine learning and so forth, is there a technological component to it, or it's more of actually building the database of lenders and so forth?
Yes. So it's entirely automated.
Okay.
I mean, now we're still building out like a some of the communication components,
Mhm.
but our goal is to build the entire pipeline is entirely automated. So like, you visit our website, is you create an account, you submit a deal, that deal is packaged up, it's run through our entire database of lenders, it's sent out automatically to everybody who's relevant, and then they feed deals back to us, and then it goes out to you guys. So it's like it's an automated process. I mean,
Mhm.
it's right now I'm still packaging up the loans as they come back into us, but
Mhm.
that's just because like we deal a lot with newer investors, and it's like it's easier to help them understand it if I'm directly emailing them and giving them a little bit of insight into the loans. But eventually, once
Mhm.
the communication platform is done, you'll be able to go back and forth with the lenders directly on the platform. You can chat with them, you ask questions,
Mhm.
get a clarification on terms, all that kind of stuff, without ever
Right.
having to uh it's lead the platform, which does a lot for you because we vet all the lenders. Like, I have a ton of background in this stuff, so it's like I
Mhm.
know how to vet lenders. I know how to ensure that they're lending within their risk tolerances and all that kind of stuff.
Mhm.
So, which is a whole another side of what we do. We actually do risk analysis and all that
Mhm.
kind of stuff for the lender. So we know like a good chunk of their book
Mhm.
if we're sending them a lot of deals. So we know if they're pushing like a limitations of their risk book tolerances.
Mhm.
So we they might have a loan from us that they could lend on, but they have too many loans with us in this geographic area, so we won't even send it to them. So
Mhm.
like we're protecting them, as well as ensuring that our borrowers are working with vetted
Mhm.
groups.
But so let's say the general mortgage brokerage industry, let's say, like, do they cover some of asset-based lending, or do they typically go to
So
asset-based lenders, or just not so common, or like where is, I'm just trying to understand, like, you guys contribute in terms of just essentially mm, kind of sourcing like kind of this newer industry of asset-based lenders and bringing it forward, and focusing on that. It
yeah,
sounds like.
yeah. So we do a lot of we're mostly
Mhm.
focused on the latter, but to answer your initial question,
Yeah.
the most mortgage brokers have no idea about any of this stuff. Like, if you go to a mortgage broker and your loan request doesn't fit in a nice little box,
Mhm.
they won't even answer you, right? Like, it
Yeah.
it it
Mhm.
it's not that they will it it's not that they won't even tell you no. It's just that they won't even spend the time to tell you no. So
Mhm.
it's like we are very heavily focused on a very specific niche of customers, and those are people who are investors, and it
Mhm.
allows us to offer them a better product, a better experience, and a highly tailored product, as
Mhm.
opposed to trying to cover all of a spread of the rainbow here, and deal with
Right.
every customer that's looking for a mortgage. Because if we
Yeah.
did that, like, we'd spend 95% of our time answering questions about how do people fill out a mortgage
Yeah.
application
Yep. Sure.
to properly put their
No, yeah.
income numbers.
Yeah. No, you guys
It's like,
serve investors, and I know I've spoken to like George Papadopoulos, who is the founder of Mofin. He's a friend. Um, so I don't know if you guys work with Mofin or other. And we've had also Lima One at this webinar here as well, and some others. And actually, yeah, I've always found that they're extremely savvy compared to other lenders, right? They're like very knowledgeable and really look to your specific needs and so forth. Um,
mhm.
Right. So are you seeing now, in terms of, let's say, in terms of the current banking crisis that is there within like smaller lenders, how are you seeing that on the asset-based lender side? Let's say in terms of balance sheets for some of
Yes.
your kind of correspondent companies, so to say.
Yeah, so there's a definite softening of the balance sheets. Like
Mhm.
there's no way to avoid that. It's just because what you got to understand is that a lot of these people who do this type of work, they are they're arms of ultra high net worth family offices or individuals. So it's like a person might be running, $100 million loan book off of their own personal balance sheet.
Mhm.
So if they've got $30 million liquid, let's call it, and they're running $100 million loan book,
Mhm.
uh, they can get 4.5% with zero risk just buying treasuries, which
Right.
is like which is their targeted return number when they're running like an asset based lending book is usually between 5.75 to like 6.5%. It's
Mhm.
like if you could do none of the work, have none of the risk, and get it's 70% of the return,
Right.
you're gonna go stick your
Well,
money over there. Yeah.
right.
So
I
I
mean,
mean,
yeah, got it. Yeah.
yeah,
Real
yeah.
return is
So
negative though, but still, but your nominal
yeah,
return, yeah, that's kind of okay. Sure.
yeah, yeah, yeah. So a lot of them have shut down 50-60% of their you know it's available it's loan balance, and they are they're still servicing just because they want to ensure that they keep their best customers, so that when things turn around, they can go, they're still there. But there's not a lot of groups taking on new customers, and that's really where we come in, because like if we have hundreds and hundreds of lenders in our network, so there's still lenders out there taking new customers, and we are working with new investors, right, to get them into those funnels as well as just
And
new customers.
this, so I kind of understand. So those customers, those lenders, so are they the originators? Because let's say companies like Morphin and Lima One, they kind of originate the loan, but then they sell it to
A mix.
loan buyers, like kind of like Turak and Pretium and like these guys, right? That's kind of my understanding. Like some of the companies that they syndicate credit, that then they have their own investors, kind of like in a real estate syndication. They have their own investors that they want to invest in mortgage credit in a way. And
Yes.
then those guys hold the loan on their portfolio. And so
Yeah.
your company would work presumably with the asset-based lenders themselves, but then how do you assess them? Because it almost feels to me like they're more like an intermediary themselves, right? They just kind of
Yeah.
find
Yeah. So a lot of the lenders are pure it's origination shops. I'd
mhm,
probably say it's 75%
right.
like pure origination, and then 25% balance sheet is probably is the rough distribution in the industry. Um,
Got it.
Ironically, a lot of the balance sheet guys are on the small side. So it's people lending 5-10 million of their own money
I see.
to investors that they
Got
know
it.
very well,
Got it.
right?
So
And then
they're sort
so
of like almost like a family office operating in a way in the
yeah,
credit
exactly.
space,
Yeah,
like
exactly.
family office kind of credit investors, I guess. Or
Yeah, yeah. And then you have, the shops doing, call it 15 to 50 million like in available liquidity to do, like in their loan book. And that tends to be people who have, yeah, call it 15 million liquid, and it's lines of credit to, fund the rest. And those lines of credit are what's actually drying up for the most part, because you can't make enough spread between what the lines cost and what you can charge. And because it takes you, even if you're selling off loans, you have to hold them on your book for a certain amount of time to build up enough of them to entice a buyer. So for example, like there's not a ton of buyers out there that'll buy one loan at a time from you.
mhm,
You might need to originate 3-4 loans for them to come up and buy that whole pool at once. So if you don't have enough, the transaction volume, you're going to be holding on to those things for a long time. So that's why those shops are shrinking, and they're only really servicing their best customers right now.
mhm, mhm.
and then you got the real big guys who, I call them 100 million plus,
Mhm.
and they have more stable lines of credit, but it's still a similar type of situation. Like Alima One, might have $1 billion in capital, available, but like they they got to cycle that out. They can't hold on to that indefinitely, and their loan buyers, are requiring them to have 50 or 100 loans at a time
So
to execute on
Lima
the
One
transaction.
is still pure origination, is it? Or is it balance sheet?
So they have they say they have a balance sheet book. Um,
Mhm.
I've never been able to get kind of a perfectly clear answer from them. I
Mhm.
know they do hold some of it, but
They don't maybe sell all of it, essentially. They might. Okay.
yeah, yeah, and the reason a lender, for example, would want to hold on to a little bit of their book is mostly just because um, they can use that as an asset pledge if they need, like, have a short-term liquidity issue. They can say, hey, if we've got a 30-50 million dollar, it's loan book over here. Oh, Mr. Bank, can you loan me, $2 million so
Mhm.
as we can get through this,
Mhm.
a 3 day a liquidity crunch or whatever it happens to be. That's the primary reason why, like, origination shops will hold on to some of
Okay,
their loans.
got it. Yeah. And so the softening of balance sheets that you mentioned, and I don't want to interrupt you actually too much on actually sharing like your full story and what you guys do, but the softening of balance sheets, are you seeing kind of a credit crunch in a way? Because I can say the past almost 3 months, I've been pursuing a lender for commercial property on my side. And I had
Mm-hmm.
like a list of 15 guys that I listed with the mortgage broker that actually that were kind of carved out that I could go directly to. And I've been like talking to them, and little by little, every single one kind of dropped out because it's a bigger value add. And at some point, it just started becoming apparent to me, apparently there is credit tightening. It's the same
Oh,
lenders. It's extremely
there
strange.
is.
That's the first time I'm seeing it since I'm investing myself. And that being kind of a bigger value add, like more work and so forth, kind of higher risk in a way, right? And so it seems like, and then I realized, oh, wow, that's actually the environment. And then I realized, okay, looking at some of what came out for SVB and those other banks, so their balance sheets, they're already deteriorated for months backwards, let's say at least 3 months. So I realized, oh, actually internally for all those banks I've been speaking to, most likely they've had like extremely weak liquidity and balance sheets already from the very point I started talking to them, So it was
Yeah.
already a priori, like they can't lend. They can't lend,
Mm-hmm.
or at least not on riskier things, or maybe they can't lend even on anything because they're just trying to handle their whole portfolio and keep it together. Under the assumption that some of them are, at least some of them are similar to what would have been at Signature Bank, which is also in New York, and that happens to be New York State there as well. So that's
Yeah.
just an observation. So I'm seeing the signs of, it's anecdotal obviously, but I'm seeing the signs of credit crunch through that
Yeah.
do seem to be there. So
Yeah. It's a blend. I would say yes, there is absolutely is some of that happening,
hmm,
but I think what more of it actually is a volatility fears.
hmm,
Like,
sure.
banks just don't know when the rate hikes are going to stop.
Hmm,
So, like, everyone's got an idea about it's when they think they'll stop, but at the end of the day, they don't really know when they're actually going to stop. So it's like, if you've been issuing loans, and you're holding them on your book, and you got to hold them for 60 days, 90 days to put a mortgage-backed security pool together.
hmm,
Like, if you've got a third of that is 50, 100 bips lower than what the current market is demanding,
hmm,
the the mark to market value of your loan portfolio,
hmm,
you've already lost 6% of that value on
hmm,
those. And if you go to sell them, you're going to have to realize a loss. So a lot of these guys, they may have the liquidity to actually lend, they just don't want to because they don't want to have to deal with that. It's mark to market loss when they actually go to sell those, it's loan books, because there's there's a weird rule in banking that as long as you're holding something on your books and it's not for sale, you don't have to take that, a mark to market loss, which is, I've always thought very weird, but yeah, that is a strange reality, but true.
Right. And so you guys, so your platform, so you consolidate or kind of like offer like as many as possible, like different. So let's say if I came to you and I wanted to shop for, let's say in the range, the second range that you guys have, because it's less on the commercial side, asset-based lending typically, but let's say the 10 to 25 unit range. And where you have maybe like 10%, 10, 15% of portfolio or something like that, like you mentioned, right? So let's say in that range, what options could I see compared to if it went directly, let's say, to Lima One and just looked at, or a couple other guys?
Yeah, so that's one of the unique things about our platform is you'll essentially get the exact same offer that if you went to them directly. We do not charge any brokerage fees directly. All of our fees are on a percentage basis of what the lender is charging. So, it's what that would mean for you is that if they charge you 2 origination points, going direct, you would get charged 2 origination points coming to us. There are a few that will up their fee to roll in ours, but the overwhelming majority don't, because they understand that this is a marketing cost, right?
Sure.
They'll absorb this if you go to them directly through a marketing spend, or if you come to us, there's no marketing spend, because we are driving a deal flow from a completely different customer set than what they do.
Okay, got it. And how do you guys source your investor deal flow? Let's say, like, what is your approach for like finding leads and like lead generation and so forth?
Yeah, so this is where we actually get into, ironically, more of the technology. We created an entirely automated natural language processing system that scrapes Facebook, classifies posts from hundreds of different real estate investment groups.
Oh, I do that, in my investing, by the way.
Yeah.
I'm sure you guys do it in a different application, but I do something like that. So yeah, you go ahead. No worries.
So we classify all of the tens of thousands of posts that are made every day in hundreds and hundreds of groups by the propensity that it's looking for financing. And we use tons, or a couple of models is that we have blended together to do that. And if we scored thousands and thousands and thousands of posts manually, I got the algorithm incredibly well tuned. It spits out probably 50, 75, 100 leads a day.
Wow, that's amazing.
For $1 or less of like a compute spend.
That's the way to do leads. Yeah, that's the way.
Yeah.
You're not gonna pay for like Facebook ads or something, right? I mean, that just makes sense. Yeah, that's the way to go. So that's awesome. So you guys, and then how do you guys reach to them? Like you get, let's say, 75 leads. They're all like Facebook profiles, right? Essentially. And you just message them or
So we will respond to their questions in the groups, or we'll reach out directly. But here's the other thing. We use the generative AI tech, and we've now automated the responses.
Okay.
Nice. So the model spits out the lead, and it spits out like three or four different like response queries, and we can just copy them, paste them in.
Which is great. Yeah, no, that's awesome. You know, I do it. I'm sure it's a simpler version than what you guys have, but I found something like that with Facebook groups to be good and useful, because I would go to probably 100 groups. So my script would go to like 100 groups. It's going to scrape all the posts and we'll classify, okay, which ones are potentially somebody putting a deal there. Now, it's a lot of it is, like wholesalers and so on and so forth, but generally, trying to find like commercial properties for sale. And, and if it's something, okay, they're saying it's a commercial property, but they're discussing what they already sold or something, or that's a deal I already did, okay, then that natural language processing would kind of ignore that, right? Just like textual classification, right? NLP.
Yeah.
So mine is pretty basic, but it still goes a long way, because think about it, otherwise you have to somebody has to be reading one post at a screen, right? You have a single screen in one post, and you can go through tens of thousands or hundreds of thousands or whatever of those. So it's definitely powerful, and I'm very glad to hear that works so well for something like that, for finding customers in your space. So
yeah, and ironically,
yeah,
we have people that we talk to all the time who are like, I'll pay for that. It's like all other products. So yeah. I mean, it's a if when we get to the point where we've it's finished a platform and have automated the entire lending process, I am going to, I mean, we can get into more of the vision in a minute, but I'm gonna hire I don't know, a handful of data scientists and data engineers and task them with the sole task of creating creating Facebook profiles to go join every single Facebook group that has anything to do with products or hobbies.
Yep.
Scrape all of that.
Yep.
And create
Mm-hmm.
create like an advertising classifier and just sell that to everybody who sells anything on Facebook.
Yep, I agree. No, it's very powerful, that whole thing. I know.
Yeah, I mean, I don't think Facebook would be too happy about that, but
yeah, I was a little busy, and I got somebody on Fiverr to write me a basic script to scrape the groups, but then I had to actually rewrite it myself, because I do a lot of scraping for other things. Scraping with legal legal considerations and so forth, but it is incredibly useful and everybody does it, so there's no way around it, right? It's the main.
Oh yeah,
it's the main way to get quality anything over the internet, quality leads or quality data or anything, right? It's pretty much.
Oh, 100%. Yeah, I mean, it's incredibly critical, but more than that, I think what it is it's just it allows you to create scale that you could not even do with armies of mechanical Turks, which for those of you who don't know what that is, that's you can go out and hire people to go manually scrape things.
Automate browser automation, the browser automation side as well.
Yeah.
These events, we would in the past, we would have them posted in other cities, and I would have a script go and post them in every group, and it just makes sense. But anyways, so it's sorry, go ahead. So that's awesome, that's great. And so that's is that your main kind of the most productive that you found for lead generation, or are there other sources?
Yeah, so right now, yes.
Okay.
We're planning on doing a significantly more stuff with email, it's marketing and things of that nature. Over the course of our scraping, we've collected tens of thousands of emails out of these groups. Verified emails.
Facebook groups, that's not okay. Facebook groups, they're so rich on that, because people, they just blast their email in the comments. That's one of those places that they're not concerned about their privacy whatsoever. They're just gonna put, okay, somebody says, oh, I want to share this, whichever, this brochure of something or whatever, and then everybody's 50 or 200 emails underneath.
Yeah. Oh, for sure. Yeah, but I mean, we're gonna attack the major vectors. So there's gonna be things like it's content. There's gonna be other forms of social media marketing. Right now, it's just the two of us, so it's we're able if we built this into shit, we're up to like $230 million, I think,
Mm,
in a loan request like this
mm,
quarter already, and it's just the two of us. So it's like
yeah.
we're building this for scale, and so we are, or at least I am, intentionally keeping the manpower low so that we have to build systems early to handle all this stuff because to give you I guess a bit
Okay.
more
Right.
background. Yeah,
So just
it's
to, I don't want to hold you just right there because that's like insane. So you're saying so you two, so you guys, you and Philip, so you guys have 230 million. So on the lead side, on the investor side, searching for a loan, search for an
yeah,
asset-based fund. You
already
accumulate
well, no,
230,
already submitted to the platform
right?
this quarter. Yeah.
Already submitted. And then for out of those requests, like how many you are able to actually honor, or let's
Yeah.
say
So
previous quarter or whatever, that would go through and kind of find a place in the market, I guess. Because I mean, because
yeah.
it's
So
incredible. Yeah, it's just yeah.
yeah, I'd say probably 45 to 50% are actually fundable because there's a lot of people who who are just don't have deals under contract. They don't have this. They got valuable deals, right? But they just you know they don't have them under contract yet, for example. So it's like,
Sure.
oh, we don't really count those as like a fundable deal. And
Yeah.
then from there we further narrow it down like on deals that the numbers just don't make any sense, right? Like
Sure.
I have
Yeah.
flippers who come to me and they want
Yeah.
a $200,000 to buy a property. They want 250 to fix it up, and then they're going to sell it for 275. And I'm like, no, no one's going to
What
do this.
so what could be like potentially that can get funded out? So 45-50% would be low fundable because let's say they may not have it under
Yeah,
contract and so forth. From there, once you actually underwrite the deals, post underwriting and offering it to some of your like lender partners, right? So how many
yep.
could go through actually? Like, would it be like 5,
So
10% or more?
yeah, so I'd say of that probably of the total, we're now probably down to 25 to 30% of that original number. So
Got
probably
it.
another 50%, like another halving
Exactly. Yeah, yeah,
of
yeah.
that number.
Got it. Which is amazing. So that's great. And that's you guys just basically built it by on top of like customer bases from Facebook and so
Yeah.
forth, sounds like, right? And then the
Mhm.
lender contacts, so those are just like your own relationships and like building relationships.
That, but they're
That's
purely
easy, right?
inbound. Like I think I've reached out to like 3 lenders the entire time we've been doing this to get them on the platform because they did some specialty type of thing.
Okay.
But other than that, no, it's inbound. Like they're emailing us asking to get on the platform.
Uh-huh. Got it. Got it. That's amazing. That sounds great. That's awesome.
Yeah,
That's
yeah. So
that's really, really awesome.
yeah, so I'd love to kind of just touch a little bit on kind of it's where we're trying to take this. It's to give you guys an idea about what we're looking to do because the big goal here is I want to control the entire pipeline for our customers. I want to be able to, have deals coming onto the platform. Our system have customer profiles that say, "Hey, I like to invest in these zip codes," right? And then when a deal pings up in a platform, they instantly get a notification and says,
Mhm.
"Hey, this wholesaler's got a deal. Here's all the metrics of it. Here's the pictures. Here's the numbers on it. Hey, if you've already got a lender who says that they're willing to lend on this, bam, put the whole package together so that they can literally just go and like the buy it now button, on eBay, like the one
Mhm.
click button on Amazon, just be like, bam, and it's done. The contract's executed.
Yep.
It's already funded, and that's like that's how I want to build the top of the funnel for our customers, for deal flow, and
Mhm.
then all the way through exit. Like I want to have like a light property management app. You know, I want to be able to provide analytics and growth projections and all this kind of stuff, all these different types of data services and everything for the customers as well. And then be like, hey, are you tired of this property? Well, I've got 50,000, 100,000, 250,000 investors over here who would be happy to buy it from you.
Mhm.
Like allow them to buy, fund, manage, and sell all of their investments all in one place.
Mhm. Right, which is incredible. Yeah, that's amazing. But
I mean,
you think so? Let's say mortgage, let's say the mortgage brokerage industry, right? How do you think they source looking at the older time thing? Let's say, kind of, how do you think they source their leads? It's just kind of word of mouth and stuff like that, or
yeah, so like there's word of mouth, you can buy its list of investors, they'll talk with a real estate brokers, who work with investors. You know, there's a lot of traditional ways of doing this.
yeah,
Actually, a lot of the people that we compete with, ironically, they use Facebook as well. So it's like,
yeah.
but they're all like, they're copying and pasting their little
Exactly. Yeah, they're
like
not gonna do
business
that.
card images
I
in
know. Yeah,
in
I know. That I
yeah,
get it. Yeah, it's like same
yeah,
thing with investors. Everybody is on these groups, but they're not gonna do like what I do in that one because it's like because it's like they're not gonna web scrape 30,000 posts.
yeah, yeah. And I mean, like, I think our big advantage is that
Mhm.
we look at these problems as fundamentally problems of scale, and
Yep, yep, yep.
and then we look at solutions like almost entirely from a technological perspective. Like, how do we use technology to improve the lives of our customers? Like,
Yep.
it, our customers just happen to do real estate investing because I know a lot about it, and
Mhm.
that's like the only reason. But like, we could basically take what we're doing, pick it up, and put it on a different product set, and I think we would approach it in the exact same way.
Right.
It's finding
Kind of a
a solution.
marketplace approach.
Well, I mean, like,
Yeah. Okay. Mhm.
not like, yeah, it's not necessarily a marketplace, but like
Mhm.
the same kind of a technological solutions
Yeah.
approach to the problem. You know,
Right.
be it a marketplace or like like a CRM system or whatever. Like,
Yep.
but basically a way to improve the lives of our customers, and that's really what we're looking to do.
Mhm. Interesting. Okay. So I guess we're a little bit over time, but like, what are some, I guess, other things we didn't cover, like that you wanted to share today with our audience, Michael?
I've got time, so if people got
Yeah.
questions,
Yeah. Let's see.
I'm more
Like,
than happy to
actually,
answer.
okay. Sorry. So Eric has a question. Go ahead, Eric.
Hi, Stefan. Hi, Michael. How are you?
I'm doing well, thank you.
So question, actually, I'm in the process of doing a refinance on a paid up property here in the New York area,
Hmm.
and it's a mixed use property, and property value is about 900,000, um, and I'll be trying to cash out refinance it. You guys you'll be able to do a deal like that?
Oh yeah, yeah. I mean, we do, a number of like of refis. That's probably 60 to 75% of our business right now. But the could you give me a little bit more information on what you mean by mixed use?
So it's one commercial, one residential.
Okay. And where is it? Is it
It's in
in the city?
Middle Village in Queens area, Queens, New
Okay,
York.
yep. Yeah, yeah. Yes, I know the area. Are you do you have a long-term tenant in place on the
Uh,
like
on the
okay.
commercial?
No, on the on the residential side.
Yeah, they're all long term, but they're all month to month. I went in there, I purchased the property in August. I raised all the rents, and now I want to cash out.
Okay. Yeah, no, I mean that's fine. I would make a couple of suggestions before you do go to do a refinance. Is one, you get a long-term lease in place of with the residential tenant. It'll just make the process 10 times easier. And then on the commercial side, what type of tenant is it?
Nail salon.
Okay. Yeah. You should be fine there. How many years are left on their lease?
So the commercial, this is month to month. The
Okay.
upstairs, I gave them a lease back in November for a year.
Okay. Yeah. So, and the same goes for on the commercial side. Like, it's going to impact your ability to raise the rents more, but it's going to make the refinance significantly easier if you can get them into, like a 5-year lease. Now, you can, assign a rider to the contract afterwards. It's like, hey, if you need to get out of the lease, and we both agree, you can leave, just give me, X number of days notice. But you got to be, it's a really difficult time right now to do a refinance on a commercial property, just in general, and it's almost impossible if you don't have a long-term lease in place. So that's the first thing that I would suggest, and then is second on that, right, is the pricing is going to be a little bit difficult, just because most of the commercial guys don't like to do deals under $1 million, but I'm pretty sure we've got, thinking 20-25 lenders in our network that would potentially be interested in something like this. And if not, I can go to the family offices. It's that I know here in the city, and you can, probably get, like a 3-year, 5-year, it's loan from them, and then it's refinance it in, a year or two when the value of the property rises because the rents have gone up.
Now, for when you say long term for the residential side, is that good enough though? It's a little bit less than a year.
Oh yeah, no.
No.
Yeah. It's what I meant by that was that you just have a long-term lease in place. It doesn't matter if there's 2 months left on it or if there's 11 months. They just like to see an actual, like, real lease in place, and not just, somebody on a month-to-month it type of situation.
That's fine. Now, the issue I'm having is like, the lenders I've been talking to, they say they'll give me 70% loan to value, and when they run the numbers with the expenses, they say we could only give you 350 to 380 maximum.
Yeah, and like a DSCR is going to be a big one right now because of where interest rates are. How long do you have left on your existing loan?
There is no loan; it's paid out.
Okay. Okay. So yeah, so if it's paid off, I would, and this is going to sound is counterintuitive because we make money on fees, but you might actually want to wait until late summer, early fall. And the reason for that is because I've been hearing a lot of rumblings from my, friends in the finance industry and the banking industry that they're expecting rates are going to start coming down like midsummer, and will continue to fall through probably early fall, and then maybe plateau, call it a 75 to 100 bips lower than it is now. And in that case, that will create significant a relief pressure on the DSCR side of the loan, and will allow you to get significantly more proceeds.
Got it. Yeah, because it was a little bit too low of the amount they were giving me, right? And or just doesn't make sense,
Mm-hmm.
Perfect.
And
thanks. And then okay, go ahead. Sorry.
Yeah, I was gonna say I'm imagining that has a lot to do with the fact that the interest rate that they're probably offering you, is it in like the 7s and 8s or higher?
Yeah, actually, I did find someone that came back at like 6.5, but that's with 2 points.
Yeah. So I mean, even at that, like, it's the New York's kind of a weird market just because prices are oftentimes disconnected from rents, and especially in that kind of small, a sub 4 unit space, because oftentimes those are priced even for owner occupants, even if they have a commercial space inside of them. They still qualify for kind of the owner, it's the owner occupancy, like QM loans,
Right.
so you can get
Yeah.
much higher leverage on those. So
It's kind of a
Yeah,
mix.
there was
I would think. I'm sorry. Go ahead, Eric.
Yeah, sorry. Actually, Michael, there was one lender. I don't know what kind of lender he is. I think he works for United something bank. And
Hmm.
he said for this mixed use, he could actually give me a residential loan if the square footage of the residential is greater than the commercial.
Yes, correct.
And normal banks won't do that. But he says they just changed the seasoning from 6 to 12 months.
Yeah. Yeah. So that is that is the case on most lenders will actually do that. They just don't like to because again, it goes back to that little box that I was talking about, right? If it's it if your loan application fits inside that nice neat little box, they can stamp them out like like cookies. It's coming down an assembly line. You can just like it stamp them out really quickly, and if there's like hair on the deal or whatever, it takes them way longer to do it because they're just not used to doing it. So that's oftentimes why people say no, is because it's like, hey, this is going to cost me twice as much time to do, so I'm just not going to do it.
I see. You think it's so if I apply with your software, it's online application, right, on your website?
Yeah, correct.
So if I just want to try it out to see what I'll get, what options. Um,
Yeah.
you
Oh,
gotta
for
give
sure.
us the website. I guess you should.
Oh yeah. It's just www. It's just www.c as in cat, O as in orange, R as in race car, E as in elephant, L as in land, A as in apple, N as in Nancy, T as in Tom.com. And I'll
Correlate.
yeah, like I'll put it in the chat as well.
All right, great.
But it's just one of those things where it's like it's a um you know if it's more work for them, they're just oftentimes they just want nothing to do with it, and that's the big problem. Is that people, they do what they know, and they, don't do anything else.
Mhm. Yeah, I
Okay,
just
thank you
put it
so
in the
much.
chat actually. Yeah, corewant.com, right?
Yeah.
Yeah,
There it is.
yeah. So that's great. Um, yeah, I mean, I feel like some of the small commercial I've bought some like small, like even 5 unit in a lot of markets. I feel it sells on comparables, sort of. It's not even in some way, it's not always truly based on the income approach, right? Even the
Mhm.
valuation of those. Because it just, I feel like one is just the supply of comparables, because appraisers are gonna now be conservative between what are other buildings selling for, because you just have a big supply of 6 unit buildings. There's so many of them, like sometimes, right? And then the other one is just like what you said. There's an owner occupancy potential as well. How is that factored in and so forth? And so it's pretty interesting. I always found that space like extremely interesting, actually. Like, thanks, Eric, for joining us today and that. So, yeah, does anyone else have other questions? If you wanna kind of raise your sorry, you wanna raise your hand. So
Or just jump on. Doesn't
yeah.
bother me.
So okay, so Michael, what is the best way to reach you? Now you mentioned your website, corawan.com. I moderate myself, checking it out. So what are other other ways like LinkedIn or your email address, etc., that you want to share with us, perhaps?
Yeah. So, my email is just michael@corla.com.
Mhm.
And my LinkedIn is it's Michael Heisterkamp. I think there's only like a couple people with that
Good.
name. But I also think I'm the only one in the US. But
That's true. That's what I would
if
think. Yeah. Okay.
but if you're connected with Stefan on on LinkedIn, I'll be the only one that's a second level connection.
Yep.
That's definitely for sure.
Yep. Sounds great. Okay, well, that was awesome, Michael. Like very, very inspiring story on your like your product that you guys have. I'm very glad it's working great, and bringing up that revenue and so forth. So it's really great. So very interesting for me personally. I'm sure for others as well. And
Yeah, for sure. And I mean, I literally don't have anything else to do tonight, so I'm more than happy to answer like kind of any questions, industry questions. It's economic, it's questions about the industry or whatever. If not, I'll definitely it's hop in again in the future, and we can,
What is your view? I mean, I guess just I have one question. Actually, Eric, go ahead. Eric, raise
Yeah,
his-
sorry. One more question, Michael.
no
So do
problem.
you guys, since you work with family offices, right? Do they follow, different guidelines, from what banks, with their this DSCR limits and all that? Would they look at the deal and say, okay, even though, basically, give funding based on a different approach, pretty much?
Uh, yes, they can. Um, but a lot of that has to do with structuring. So if you're going to bring a family office into a deal, it's 9 times out of 10 going to be on the equity side, first, and then the debt side second. So while a decent number of family offices do hard money lending, like asset-based lending, they do that through a kind of a structured process. So it's like they have underwriting, they'll go through it in a very similar way that a bank will. They'll just have a different level of risk, like it's risk tolerance. So, they can do higher LTVs, they can do, you know, more aggressive things like it's fund rehab, for example. Um, then it's that like a bank won't do. But yeah, I mean, I'm like, I can bring deals to them. I know, dozens of family offices here in the city. I used to work for one actually. And so I can always ask them, and if if they won't do it, they know 50 other families in the city, and around the country that probably would. So
But they always want equity, those offices. They want to just interest on their funds.
yeah, so I mean, it's not always like it depends on what group you go to and it's what type of focus they have. I mean, there's a bunch of family offices out there that do credit only, like they're only on the debt side, but their approach through debt would be like things like it's preferred equity, which is technically a debt instrument, but it has like some equity benefits. And there's others that'll, just do lending. So they'll do like bridge lending or mezz lending and things of that nature. So yeah, I mean, it it covers the whole gamut, but generally they will want to have a say in the deal, more than just like, hey, here's my money, it's paying me X interest rate on it.
Yeah. Hey, thanks so much.
Yep.
Scott, go ahead.
Hey, Michael. I wasn't going to ask, but since you insisted, here I am. I'm curious. There's a lot of doom and gloom right now in the news about office, and with the high vacancy rate. So I'm wondering if you have any thoughts on that. If there's like a big storm coming in office, and maybe if you don't have anything to say regarding office specifically, just if with your exposure to the business, if you see a lot of borrowers behind the scenes who are kind of like in trouble or reaching maturity dates on their debt, who are going to have a hard time refinancing, trying, I guess, to get a perspective on what, like, how bad you see the market getting before we kind of like begin a recovery.
Okay, so a full disclosure here, I am very bullish on office. So
I like that.
Yep.
I'm currently actually should be getting the contract tomorrow. On a 1.5 plus million square foot office building here in the city. And it's my opinion of office is it's going to be a pure feast and pure famine asset class. Like there's gonna be nothing in the middle. It's gonna be the A class, a top of the B class buildings are going to get 100% of the tenants, and the lower Bs and the C class buildings are just going to be, they're either going to have to be torn down or, completely it's repurposed in some other way. The only exception to that, I think, is going to be suburban office, and that's just because, like, things that would be considered C-class offices in the urban spaces are probably going to have a much higher, its classification rating in like the suburbs, just because there's not, 2 million square foot office buildings out in the middle of the suburbs. They just don't exist. So those are going to be, more shielded, I think. But it's really all about ability to repurpose. And there's probably a decent amount of the Class C buildings and Class D buildings here in the city that can be realistically repurposed into its multifamily. It's going to be very painful though, because you're going to have to give up very large units, and it's not like you're going to be getting 300 square foot studios in a 25 footer office building that's got 2,000 square foot per floor or more. It's just not going to happen. Like, you don't have the light wells, if you don't have window access, you don't have all that stuff. So you're going to have to do something with it. And in my opinion, it's a lot of them are going to be tear down, and it's rebuilt. They're going to be like brand new, condo towers. So, but that's going to take some time for the city to get there on zoning.
But your bullishness, just kind of on add to that, like your bullishness on Class A office.
Yes.
So is that like for in specific cases, or like what are like kind of the criteria or like categories that you're specifically bullish for there?
No. My bullishness comes down to like its class of office. So it's like if you have like a high class office, like Trophy or Class A.
No, that I got. That I understood. Yeah.
Yeah.
And from there, so let's say if it's Manhattan, so anything that's kind of a high class spaces, you would be bullish on, or would it be specific categories within that?
No. So like it's purely a classification play.
Okay, I see.
Yeah. And the reason for that is because while companies can downsize their office footprint, it's going to be very difficult for them to fully like leave an office space. So if you have 150,000 square foot in a Class B office now, and your budget for office is, just for easy numbers, call it $50 million a year, right? You can go down to 75,000 square feet, and you can take a nicer space in a better building, and still end up saving money and only spend call it 40 million. You're getting half the space, but you don't need it because it's you're having hybrid work and people are in the office 2 days a week, and then they're hot desking. So it's like you can get away with less space. So and then you're paying more per square foot. So this is why I'm bullish for Class A, because you're gonna have more tenants in these buildings. You're gonna have a more varied, like it's wall on the buildings, and you're gonna have people paying more money. It's just like it's great economics.
Yeah.
And like you can pick these things up for 50, 5, 60, 70 cents on the dollar right now, because everyone just is in this understanding that like offices are going away. And it's just like in certain industries, sure, like in tech, where you recruit for a very different type of personality. You can probably do it, but like in most businesses where I mean, if my family owns and runs a lot of businesses, right? Like 75 to 80% of the people that we employ need active management. Like it's just reality,
exactly.
right? Yeah, like
so it's a classification, but it's also an industry kind of.
Well,
industry situation there as well, right? Because if you're in San Jose and purchasing Class A offices in San Jose, presumably with white collar workers, tech workers living in San Jose, that might not be the most optimal in that case, I would think.
Well, I mean, yes, like there are other factors, but at the end of the day, what it really comes down to is like even tech companies, like they're going to need office space, right? Because this is also a generational question, right? So I'm in the millennial generation. Like people in my generation, they love to get together, they love to collaborate, they love to work together. It's like you got to put those people somewhere. It's like just because Gen Z people it's like to live in closets all by themselves doesn't mean that literally everyone is that way. So yeah, I mean,
let's take we have a question by Eric. Eric, go ahead. Sorry.
Oh, hi, Michael. I heard that in the city, the mayor wants to convert a lot of those offices into residential units. What's your opinion about that?
And it's fine. It's just like it. I just don't think politicians understand the realities of what the spaces are. Like that's going to be the big problem, is that a lot of these spaces are just they're not designed or set up for its residential use case, right? Because like you need windows in residential properties. Like you need a secondary fire case. I mean, you need that everywhere, but you need them in different places. So it's like every bedroom has to have a window by law. So it's like there's no way around that. So it's like you can't put bedrooms in the middle of 30,000 square foot office, floor plates. It's just
simple conversion. It can be like
physical,
right? I guess.
Yeah. I mean, if you can buy a building cheap enough, you can do anything, right? Like I can take a 2 million square foot building that's a giant, square. I can cut the entire middle of it out, move all the elevators, and build a light well, right? And I can, a double. It's the window exposure. But the thing about that is that costs a lot of money, right? So you have to pay basically nothing for the building, and then you spend, tens to hundreds of millions of dollars converting it, and it's like that's just not viable in most cases. So I think what's going to happen is a lot of these are going to be tear downs, and they'll be, brand new construction stuff.
Thank you.
Yeah, thanks, Eric. I have a question actually before we wrap up. We're way over time. So since you're on the lending side, so I watched. Not sure if some of you guys have watched this. So I watched the Owen podcast actually last week, which is, I believe it has like two people. It's like four co-hosts. Two of them have like a 10-digit net worth, and then like two of them have like a 9-digit net worth. So like two of them are billionaires and two of them are like 1 digit less.
Almost there. Right? They're almost there.
Yeah. And so they actually had like very good discussion. And so a lot of the premise of it was, okay, so we are now in like kind of, okay, there's banking crisis. And what they were seeing is like a step two is CRE debt crisis. So commercial real estate bubble kind of quote, or it's not a bubble, but I mean, there's a bubble and there's a bubble on the asset prices side for sure in certain markets, but but CRE debt crisis, and then the third step being government debt crisis. So sort of they see it as a very long cycle of a debt crisis gradually unfolding as we go forward. I found it very interesting. And then they were quoting like this one guy who actually did like a Bitcoin bet where he's literally like betting for Bitcoin to explode within a timeline of
90 days,
being an exit of, so to say, that being an exit of like a currency devaluation of the US dollar. So it was a very interesting, but a little bit extreme, but they were like, like pretty smart guys and like pretty well informed, presumably. And so it was quite interesting to see. So, but that was the situation there. So banking crisis, stage 1, CRE debt crisis, stage 2, and government debt crisis, stage 3. So I'm curious, like what your thoughts are. Are you seeing as CRE debt crisis potentially coming up, like from somebody in the lending industry? I know you're on the residential lending side, but still.
Oh yeah, no, I mean it's there. Like there's no if and or buts about it, because like it's not an operational crisis. Like, I mean, in some office towers, yes, but in most buildings, it's just like it's an ability to refinance at the same valuation. That's what the crisis is. Like, for those of you who don't know, a commercial real estate, like, in a lot of cases, you're not paying down the debt really. Like, you might have an amortized loan, but you have, at usually at longest 10-year terms on, a 30-year, 40, sometimes even 50-year its amortization schedule. So you're mostly paying all interest in the first 10 years anyway. So it's like you aren't working, the loan price down in most cases significantly over that time period. So you can't handle a 20, 25, 30% devaluation of the asset, because of the interest rate. So it's I mean, your building could still be worth, $1 billion at a cap rate valuation, but when your interest rate goes from, a 1.95% to 6.5%, your DSCR ability goes down significantly.
Yeah.
So
I mean,
you got to
your
more
valuation
equity.
your valuation drop kind of moves, in line with like cap rate
Yeah.
expansion, and presumably, I mean, with cap rate expansion and kind of like compensating for some of that interest rate. But exactly, yeah, you're completely right, and it's yeah. So let's see what happens. So sounds good. So that was great, Mike, and like thanks for having me here today. It was a pleasure, and again, like very inspiring.
Absolutely.
What you and Philip are doing together, it's like great progress. So happy to talk to you more. I'm sure at some of our in-person events in the future and so forth. And thanks for sharing with our audience everything today. And yeah, again, pleasure.
Yeah, no, for sure. I mean, I'm more than happy to hop on again sometimes, and I just do a Q&A. People want.
Awesome. Thanks so much.
Yep, absolutely. All right. Have a good night, everyone.